Municipal bonds represent an important category of government securities that offer unique advantages to investors. These are debt instruments issued by state and local governments, providing a way for public entities to raise capital while offering investors tax-advantaged income opportunities. Municipal bonds play a crucial role in financing community development and infrastructure projects across the country. Municipal bonds are debt securities issued by state and local governments to finance public projects. When you purchase a municipal bond, you are essentially lending money to a government entity. In return, the issuer promises to pay you regular interest payments over a specified period and return your principal investment at maturity. These bonds serve as a critical funding mechanism for municipalities to undertake large-scale infrastructure projects without raising taxes immediately. The money raised funds essential services and improvements that benefit entire communities. There are two primary types of municipal bonds, each with different security structures. General obligation bonds are backed by the full faith and credit of the issuing government. This means they are secured by the government's taxing power, making them generally safer investments. Revenue bonds, on the other hand, are backed by specific revenue generated from the project being financed. For example, a toll road or airport might issue revenue bonds, with the repayment coming from tolls or fees collected. Revenue bonds typically carry slightly higher risk, but may offer higher yields to compensate investors. The most significant feature of municipal bonds is their tax advantage. Interest income from most municipal bonds is exempt from federal income tax, which can substantially increase your effective return, especially if you are in a higher tax bracket. Additionally, if you purchase bonds issued by your home state or municipality, the interest may also be exempt from state and local taxes. This creates what is known as triple tax-free status, where your interest earnings avoid federal, state, and local taxation. This tax treatment makes municipal bonds particularly attractive to high-income earners seeking to reduce their overall tax burden. Municipal bonds finance a wide variety of public infrastructure and service projects that directly benefit communities. These include roads and highways that improve transportation networks, schools and universities that enhance educational opportunities, hospitals and healthcare facilities that provide essential medical services, water and sewer systems that ensure public health, bridges and tunnels that connect communities, and airports and public transit systems that facilitate travel and commerce. By investing in municipal bonds, investors directly support the development and maintenance of critical public infrastructure in their communities. Municipal bonds offer several compelling benefits for investors. First, the tax-free income allows investors to keep more of what they earn, particularly valuable for those in higher tax brackets. Second, municipal bonds generally have a lower risk profile compared to corporate bonds, with historically low default rates. This makes them suitable for conservative investors seeking stable income with lower volatility. Third, investing in municipal bonds allows individuals to support their local communities by financing important public projects. This combination of financial benefits and community impact makes municipal bonds an attractive investment option for many investors. While municipal bonds are generally considered safe investments, they do carry certain risks that investors should understand. Interest rate risk means that when market interest rates rise, the value of existing bonds falls, potentially resulting in losses if you need to sell before maturity. Credit risk refers to the possibility that the issuer may face financial difficulties and be unable to make interest payments or repay the principal. Liquidity risk arises because some municipal bonds may be difficult to sell quickly in the secondary market before maturity. Call risk exists when issuers reserve the right to redeem bonds early, typically when interest rates decline, forcing investors to reinvest at lower rates. Municipal bonds are particularly well suited for certain types of investors. High-income earners in upper tax brackets benefit most from the tax-free interest, as the tax savings can significantly enhance overall returns. Conservative investors who prioritize capital preservation and stable income over high growth find municipal bonds appealing due to their lower risk profile. Portfolio diversifiers seeking fixed income alternatives to balance their equity holdings can use municipal bonds to reduce overall portfolio volatility. Finally, investors who want to support their local community and contribute to public infrastructure development find municipal bonds aligned with their values. Understanding whether municipal bonds fit your financial situation, tax bracket, and investment goals is essential before investing.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.